Is a recession coming in 2026? Headlines suggest a loud yes. For smart investors, the question isn't when it starts, but how you are positioned to survive it. Most people wait until the market crashes to make a move, but by then, it's often too late. Today, I'm not just going to talk about the economy or share scary predictions. I'm going to give you the exact blueprint for the best recession-proof portfolio for 2026. If you're worried about a market crash but don't want to sit on the sidelines in cash, these are the 3 specific safe haven ETFs you need to protect your wealth while still capturing growth. But before we dive into specific tickers, we need to understand the anatomy of a recession. In a typical downturn, liquidity dries up, and correlation goes to 1. This means that almost everything, stocks, crypto, and even some real estate, drops at the same time. To beat this, you need assets that are uncorrelated. You need a portfolio that acts as a fortress. The first asset in our defensive blueprint, and perhaps the most critical for your core equity holding, is the iShares MSCI USA Min Volume Factor ETF. During a bull market, everyone wants high beta tech stocks that soar, but when a recession hits, you want the low volatility factor. USMV focuses on companies that historically have much lower price swings. These are the fortress companies, the giants in healthcare, utilities, and consumer staples. When the S&P 500 drops 20 or 30%, a low volatility fund like USMV is engineered to drop significantly less. It provides you with what we call a smoother ride. By losing less on the way down, you need much less effort to recover on the way up. This is the mathematical secret to long-term wealth. The second critical piece of our recession shield is SHY, the iShares 1-2-3-year Treasury bond ETF. In a recession, cash is king, but in 2026, sitting on literal cash in a bank account is a missed opportunity. Short-term treasuries are the closest thing to cash, but they pay you a yield. They are backed by the full faith and credit of the US government, making them the ultimate safe haven. But here is the tactical reason why you need SHY in your portfolio: dry powder. When the stock market eventually hits the bottom, when the fear is at its highest and high-quality stocks are trading at a 40% discount, you don't want your money locked in crashing stocks. You want it sitting safely in SHY. You can then sell your stable treasury shares and use that capital to buy the dip. SHY isn't just a defensive play. It's your future offensive weapon. It ensures that while others are panicking, you are shopping for bargains. The third and final ETF for your recession fortress is GLDM, the SPDR Gold Minish. Gold has been the world's ultimate store of value for thousands of years, and it remains the best hedge against currency devaluation and economic chaos. In almost every major market crash in history, gold has either held its value or increased as investors flee to safety. In 2026, with global debt at record highs, gold is more relevant than ever. By holding a small percentage, usually 5 to 10% of your portfolio in a low-cost gold ETF like GLDM, you ensure that your purchasing power remains intact even if the paper markets fail. Unlike individual gold mining stocks, which can be volatile, GLDM tracks the physical price of gold, giving you pure protection. Now, let's talk about how to assemble this. A recession-proof portfolio isn't about being 100% defensive. That would be a mistake. You still want to participate in the upside if the recession is mild or delayed. I recommend a shield and sword allocation. Keep 50% of your portfolio in a broad market index like VOO for your long-term growth. Then, allocate the remaining 50% into these 3 defensive pillars: 20% in USMV for low volatility equity, 20% in SHY for liquidity and safety, and 10% in GLDM for gold-backed insurance. This balance allows you to stay in the game while significantly reducing your drawdown. The maximum amount your portfolio could drop during a crash. The biggest mistake investors make during a recession is emotional. They see the red numbers on their screen. They read the doom and gloom news, and they sell everything at the bottom. By building this recession-proof structure today, you are taking the emotion out of the equation. You are giving yourself the psychological permission to stay invested because you know your downside is protected. In 2026, the winners won't be the ones who predicted the exact day of the crash. The winners will be the ones who built a portfolio that didn't require them to be right about the timing. They built a portfolio that was ready for anything. Which of these 3 defensive assets do you trust the most during a crisis? Are you leaning more toward the safety of treasuries, or do you believe gold is the ultimate protector in 2026? Let me know in the comments below. I want to hear your strategy for the coming year. If you found this deep dive into recession protection valuable, please hit the like button and subscribe to the channel. We are building a community of disciplined, long-term investors who prioritize wealth preservation as much as wealth creation. Thanks for watching, and I'll see you in the next video.